Good afternoon to all of you. I am Dr. Sanjib Pattnaik. I welcome you all to this particular session where we shall be learning about a particular course that you are having as equity markets. It has been coded as MMPF 007. Now, in the earlier sessions of this particular course, we had covered up the basics of the equity market. That means what are the instruments, what are the primary market, what are the secondary market, who are the regulators, how investors' interests are protected, all these things. Now, as we came to the block 4, which comprises of valuation, here we try to say that an investor enters into the market in order to generate some return. The long term return, usually we say. The long term return can happen either through capital gains or through the interests or dividends that the investor is getting out of the security. Now, why should we evaluate the thing? Now, suppose, for example, we go to the market and find there a certain item which we want to purchase is priced at rupees 100. But according to my feelings, I try to frame an idea about the product. So, what I do, I look at all the basic characteristics that are present in the particular item. That leads me to frame the price of the item, which can be equals to the market price, can be greater than, or can also be less than the market price. So, if it is the price which we are trying to derive out of the characteristics of the product, which in other words is called as intrinsic value. Suppose the market price is higher than the intrinsic value of a security. That means a security should have been priced at rupees 100, but it is selling in the market at rupees 110. Immediately we know that the item is overpriced or overvaluation is there. So definitely this knowledge will enter into various investors' mind and the market will start correcting itself so that the value or the market price of the security tries to come near or equals to the true worth of the intrinsic value of the security. So, reverse is also the same case. Suppose we try to purchase an item which has a market price of rupees 100. Now, when we reach the marketplace, in our mind, we have framed the price should at most be rupees 110. So when it is 110, the price should have been 110, but it is selling for 100 rupees. That means it is a undervaluation case. So we try to search for these items so that we can procure it. In other words, buy the securities which are undervalued. And we try to sell the securities which are overvalued. Now, in order to determine this particular intrinsic value of a security, we try to go by a school of thought called as the fundamental analysis, whereby the analyst or the investor tries to half the intrinsic value of a security by looking into the framework which is called as EIC framework. E for the economy, I for the particular industry of the target company which we are intending to purchase, and C is the intending company. So we try to look at these three aspects: E economy, I industry, C for company, so that we can have a judgment of intrinsic value of the security, of the true value of a security. Then we try to compare that with the market price so that we can know whether the security is overvalued or it is undervalued. Now, this is the essence behind the school of thought which we call as fundamental analysis. Now, when we look deeper into the thing, then we find the market usually doesn't wait for this kind of analysis. Investors don't want to go through this kind of analysis. That means the fundamental analysis. They want quick decision making. That means when to buy or when to sell. So this quick decision making of when to buy or when to sell, or in other words, we say the timing of the transaction, then it is dependent on the market swings. That means market, if it is swinging upwards, even though the company is having its fundamental as bad, they automatically sometimes get dragged upwards. That means securities of those companies, they also get higher and higher. Similarly, river is the case. So looking at the market swings, investors try to judge the timing of the transaction. And this is provided by the second school of thought called as the technical analysis, where we shall be looking into the timing of or the signals for buying and selling the securities by use of various kind of charts, oscillators and indexes. Apart from that, we also have a very popular Japanese technology called as the candlestick. Now, let us move into this particular school of thought whereby we can have the timing of the transaction, whether to buy or sell, is called as our technical analysis. So, our topic of discussion today is technical analysis. Now, in order to acquaint ourselves with the technical analysis, we have already seen in fundamental analysis, the investor finds the valuation of a security for decision making. How does the investor finds the value of a security or the intrinsic value of the security? Through the EIC framework. It analyzes the economic conditions, the industry situation where the particular company belongs to. Suppose a particular bank, SBI, security, I am making my mind to invest. So I will be looking at first the general economic conditions in the country. Second, I'll be looking into the banking industry as a whole, how they are performing. Then finally, I will boil down to the last one, that is, we can say, the company analysis. That means taking the past periods, documents, the reports, etc. of the company, we can generate various kind of ratios like the coverage ratio, like liquidity ratios, like the capital gearing ratio, etc. etc. Now, this helps to determine what is the true value or the intrinsic value of a security. But as we said, in technical analysis, the investor does not depends upon the fundamentals behind the true value of a security, that is EIC. What it depends on? Now it depends only on the stock market data for the decision making. Now, when we are talking of stock market data, what are the stock market data we can take? Now, it is first of all the price of the shares or the securities. Then, the apart from price, we also talk of volume of the transactions. That means which security is having a higher volume of the transactions, and various other market related data only. It does not move behind towards the EIC, economy, industry, and company analysis. So here, what we try to do, what are the components of the technical analysis? Now, here we try to prepare various kind of price charts, volume charts, the Japanese candlesticks, etc. So, components include charting the market data and some kind of oscillators. So, when we say oscillators, then that is a device or a mean which is moving either above 0 or below 0, or the central line, we can say in a simplified way. So these are the components of the technical analysis. It is less difficulty in today's time due to free online services of the components. Let us look deeply into that. Anyone nowadays in Indian subcontinent can participate, or anybody can participate or look at the market data in various kind of electronic medias. There, if we are looking at some kind of market data portals, all these things will be coming in form of charts as well as oscillators, and they will be clearly indicating that when to buy or when to sell. So we are saying in technical analysis, the investor depends only on stock market data for decision making. Here the decision making process is dependent on buy or sell. Everything you can find or we can find in our the online, the displays, etc. Assumptions and limitations of technical analysis. Now, what are the assumptions that we generally have under technical analysis? Here, every information is discounted by the market. In other words, uh, we can say that the information that is coming for a particular company immediately is observed by the investors or the brokers or the trading platform where the investor is working on. They already have incorporated the information as and when it comes to the particular security. So, we say technical analysis is the method or the school of thought where every information is discounted by the market, any kind of information, be it union budget, we can say, be it the state budget, you can say, be it any kind of private investment in that particular industry sector, etc. Here, we try to believe in technical analysis that prices move with trend. So, wherever the trend is going, we immediately try to put in our mind that yes, trend is there. So, we shall start asking our near and dear ones, friends, etc., to visit the place. Now, when that is being done, we say the extra persons who by learning from us regarding the particular place have gone, they have gone why? Because there is a move towards those particular places. So here also we say the security prices move with the trend. That means whatever is the market trend, whether it is upwards, security prices in general will also be increasing. Market is dull, then we say the prices of the security will move with the trend and it will try to come down. History tends to repeat itself. We say that in technical analysis, it is the history, past information that is coming to the forefront. And the prices are mostly dependent on the demand and supply factors. Now, coming to limitations, no signal, only noise. Who can tell with an example? When we say this question, no signal, no noise, it is definitely targeted towards the security prices and the timing of the transaction. That means if we want to buy or sell the thing. Sometimes the charts under this technique they try to move upwards for 2 or 3 days and then it again comes back to its normal position. One may say that market was rising during the last 5 year period. If it was rising, why did it fail this year? Or in other words, that could have been a noise only. Noise means somebody giving some kind of information, but not any kind of signal regarding the buy or sell. Second thing is lapse in time of trading. Now, suppose I want to trade, that means buy certain securities from XYZ person. That means a single person I'll choose and I'll buy the things from him. Here, when we try to jump into the bandwagon of the market trends, then at the time of entering for transactions, there will be a definite lapse. and within that lapse the market will also be fluctuating. So that is what we are trying to say. There can be lapse in time of trading. Skewed opinion. If all of us might have seen what is the meaning of skewness, then you will find it is dependent on positional averages, whereby we try to determine how much is the concurrent items that has to be tested. So we can have a skewed option. The reason being, this is mainly dependent on sentiments. So opinion can be skewed. Sometimes the technical indicators like charts, the oscillators, the Japanese candlestick, etc., they give conflicting signals. One may be giving the buy signal, whereas another can also give you the sell signal. It depends on our assessment how the future will be behaving. So thereby we try to advise them that you try to invest today. Let us see after 2 months or 3 months what is happening. So these are the limitations that we have. Now let us go into two theories that have laid the pavestones for success of this technical analysis. First is better known as the Dow theory. It was devised by Charles Dow in 1896, and he was of the opinion market discounts all the information. Now, when I say right, there are three types of market trends: primary or major, secondary, and finally minor. But before starting anything, I would like to add what are the prices of a security that we can have in a day. Now, this price, we can say each security will be having a day high. Then we can have low. Then we can have opening, and then we can have closing prices. So, four kind of prices we can have for a security in a given day at most. Suppose I try to show it on a graph. Suppose this is the highest. This one is the second highest. Then we can have third type of price that we can have here. That is the closing price. And we can also have a low price. Low, here high, here opening and closing. Now these four prices will help us to determine when to buy or when to sell. So the primary or major trend lasts a year or above. Suppose through the platform I find a certain graph of a particular security, or you can use here the indices value. So let us take and see for the last 20 days what has happened. This is imaginary. You can use line chart here. So having the line chart, what I can do, I'll try to have a line, prediction line that goes through the middle. And what is this called as? Another zeroth point. This is called as the zeroth point. Now, here we are looking at a pattern which, if we draw a line, it is moving upwards. That means we can say the market is becoming, I presume all of us understand the meaning of this particular word, bullish. That means we want to move ahead only, no looking back. Whatever happens, we shall move upwards. Similarly, we can have also a secondary, the bearish market, where if this is the line, their action starts from. So, as we are discussing about, here we have put some kind of lines, and the patterns can be anything. You can see there is a steep rise. Now, instead of doing that, suppose in my graph, the closing prices are looking like this, then it is a sell as quickly as possible. Here, try to buy. So let us check and put here the dot. Now you can see the trend lines that we have here and here. One is moving upwards, one is moving downwards. So the general shift we can visualize from the charts, and we can have certain idea regarding the price of the securities. And if the security prices are going to fall in the near future, and we have purchased the securities only for transaction, short term transaction, you can also earn. So, if it is going to fall by analysis of the chart, then we try to sell it. Now, when we sell it, then we say the market is turning from bullish to bearish, because prices in general are coming down. Opposite is the case for bearish market. Now, what is a primary trend? Now, primary trend is the overall trend which goes on for a year or above. I have taken 4 years. and here are the prices. Now let us plot each day's closing price and try to visualize what is happening. Or if I draw a trend line, it is finding that the share prices are moving upwards, or in other words, market is moving upwards. Now the secondary trend, if we try to visualize this, magnify this, I've taken a portion for 3 months and I try to magnify that. Here, how can we know the trend in the short term 3 month period? Here also you are having the general thing, the general shift as rising. When we try to analyze it more closely, you will find the line will be moving this way also at some point of time. In the box here, that has been magnified. Now, when this kind of thing happens, even if the general trend is high, the major trend is upward swing of the market. The secondary trend is working in a reverse way of the market movement. And again, we can also magnify a portion of that for the price changes in a particular day. In a particular day. There, it may go with the major trend, it may go with the secondary trend, or it will be having its own trend which is different from the major and the secondary. Dow said that three stages to primary trend. The major trend that it is, there are three stages. One is distribution, second is public participation, and finally panic phase. Now the distribution phase is the information goes to each and everybody across the economy. When we are looking at the second stage, after people have information, they try to participate so that they can transact in the form of either buying the securities or selling the securities. Now, if they are selling the securities, the general trend will move downwards. If they are buying securities, that means demand is higher as compared to the supply, then we say that the prices are going to rise. Public will come to buy it as quickly as possible because the faster they purchase it, the lesser is the price at which they can buy. And the third phase is panic phase. Now, suppose we plot on a graph and the share prices are like this. If we look carefully, the share prices of each day is plotted here. You can take 1 year or more than 1 year also. When we look at this, what has happened? Now here, the distribution, the information that is passed on to the investors or the distribution phase has started. Second, publics come to participate in more numbers as they had demanded. So, public participation. And finally, when the public thinks that the prices have reached a solid high and they start to have a apprehensive view regarding the security prices. More or less, it has been seen that from this point the security price starts to fall. It may not fall, but in general, it starts to fall. So, this is the panic phase. Should I purchase a ticket or I should not purchase the ticket for the securities? Now, indices must validate each other. When we are talking of indices, those are the representation of the listed securities in the stock market. In Indian stock market, we take BSC, Sensex. In National Stock Exchange, it is Nifty usually that take part in this, the indices. So indices must validate with each other. That means both either will be saying a rising phase or it will be a downward phase. And the trend must be confirmed by the volume. If the prices are rising more and more day by day, you will find people will flock more to buy it as soon as possible because they have an idea that that is evident from the graph that they will be paying more if they don't buy today. So the trend must be confirmed by volume. Trends continue until there is a clear reversal. We can look here, the reversal is very clear. It is coming downwards. The market, after rising for certain periods, it starts to come down. Second is the Elliott wave theory. It was introduced by Ralph Nelson Elliott in 1930s. He was of the opinion that market trades in predictable patterns. That means whether the market is going to have an upward swing or it is going for a downward swing, that can be predicted easily. So for that, he tried to analyze the markets, the movement of the market, that means through indices as well as the security prices, and found that if I try to show here, we can see five upward movements in the chart and three downward movements on the chart, and the chart has this point as its highest. The security prices are highest on this particular point of time. If you look carefully, there are five waves that go in the direction of the primary or the major trend, including this. That means they are showing a upward trend. And three waves that go in the opposite direction, 1 2, and 3. They are going in a opposite way. That means their prediction is like this. So whenever we have the 5-3 pattern, Elliot was of the opinion that a reversal is going to happen quickly. In this phase, we see the market here was bullish. This phase, if I divide it, this phase all of us can see it is having a rise. And the second phase that we are having, it starts coming down. That means a reversal has occurred. That means we are entering into a bearish phase from the bullish phase. Now, this 5-3 pattern is saying that a reversal is going to start. So, here the market starts to fall. We can also have the opposite situation. But 5-3, 5 are in the direction of the trend, 3 are in the opposite direction of the trend. Is evident from the closing price graph or chart, then you know that some kind of reversal is going to start. If it is going to be upward swing, try to purchase as many securities as possible. Now let us move into the various type of charts. When we are talking of charts, basically we have two types. One is a line chart. Second one is a Japanese technology or Japanese technique that is called as the candlestick chart. Now the line chart is the simplest chart that we can have. How? Now we take the closing prices either of the security or of the index, and they are plotted in a graph. These are the closing prices. I start, suppose a security is closing price, I start plotting the data. This data you can get from newspaper, from various kind of websites, the portals, etc. And if I try to generalize these points, I draw a best fitting line which is showing a upward trend. So we say that it is the simplest and the basic type of chart, that is line chart. And how it is done? Now the stocks or indices closing price is plotted as dots and is joined by a line. So we try to join them by a line. So it is a general way of providing what is the trend that is there in the market. When we come to the second one, this one most widely used, the Japanese technique, that is the candlestick chart. Now, each share in a day has four prices. What are the prices? One is opening price, second is the closing price, then the third price that we can have is high, and fourth one is low. How can we show that in the form of a Japanese candlestick? Suppose this is a candle. Here we would like to show the four prices. This is the closing price, this is the opening price, this is the closing price, and this one is the high point or the highest value of the trading of the security, and this one is representing the low point. So now we are having a certain shape which is looking like a candle. Now, when we are having a bullish market, the candles are usually the blue, the green, and white candles. And if the market is bearish, then it is shown as the red or black candlesticks. Red or black. So, according to the color itself, one can have an idea whether the market trend is increasing or the market trend is falling. Now, what are the chart patterns that we usually see? I'll try to make some rough diagrams so that you can visualize it. Head and shoulders. Right. So these are the price, and this one is the time or days. Now, suppose I go on plotting the closing prices of a security, and I find immediately you can say from this we can visualize two shoulders like a human body. All of you see, two shoulders are here, just like human body, and the head portion is also there. So it is a head and shoulder pattern that we are having in the place. It means that from a bullish market, we are turning into bearish. So immediately all of you can say that yes, when we are having a chart pattern of head and shoulder, the trend is going to reverse from bullish to bearish. The opposite can also happen. You can see here the shoulder line and this one is the head. So in this type of pattern, which is the reverse of the head and shoulders, then we say that the market from a bullish phase is, sorry, in a market in the bearish phase is turning into a bullish phase. Similarly, we can have another pattern called as double tops or double bottoms. Immediately you can visualize there are two tops. When you are having a double top, that means moving upwards the general line, it starts falling and again starts to rise, but it starts continuing to fall. Then we say that the market is turning from bullish to bearish. The reverse can also be said double bottoms. That means market in general was bearish. Now it is trying to consolidate itself as the bullish. So you are having double tops or double bottoms. Similarly, many other chart patterns we can find. Out of them, some of the important ones are widely used ones, pennants. Suppose I plot the closing prices or the candlesticks of each day. I start. Then immediately we can find that it is forming a shape like this, which is like a pennant. Then comes the triangles. So in this phase, I can clearly have a triangle. Now this triangle can be, if the general shift is downwards, that means it is becoming bearish. Or if it is upwards, then it is bullish. Another pattern we can have is shooting star. Using the candlestick, what I do, I plot the candlestick of each day. You can find here, where there is very less difference between the opening and closing. But if we look at the high price, it has a, we can say it has shooted upwards, or in other words, it just looks like a shooting star in the sky. So this shooting star marks a reversal in the market from the bullish phase to the bearish phase. Now, apart from this, the charts, we have certain mathematical methods which are called as technical indicators, which are used to predict the market movements or the market swings. The first one is rate of change. Rate of change, how we can do it. Suppose we try to assess a 7 days time period. So at the beginning of the time period, the price was 100, and after 7 days, it has become 110. So percentage change is equal to 110 minus 100 divided by 100, that is equal to 10%. Now, this rate of change can also be positive and negative. And this positive will be, if I plot on a graph, it will be rising. Negatives are the falling patterns. And if the highest rate change, then it climbs downwards and it doesn't rises to that point. It is representing a downward swing. Here it was somewhat bullish phase and we are having a turnaround at the central point. Then second technique that we have is moving average. Suppose the closing price we have for 4 days 100, 105, 110, 108. Now I want to calculate a 2-day moving average. So when I calculate 2-day moving average, the first data is 100 and 105. So I take this as MA1, moving average 1. Similarly, I can have moving average 2, that is equal to 105 plus 110 by 2. Similarly, I can have a third moving average and I can plot a graph like this and I can have. Then finally we have exponential moving average where the last data are given the least importance. Suppose I want to calculate a 3-day exponential moving average. I'll discard the last one and give more weightage to the latest one. One of the most important technical indicators that we have is moving average, convergence and divergence, MACD. In order to calculate it, what we do? We find the difference between a 12-day and 26-day exponential moving average. Now those differences are plotted on a graph, and using a 9-day exponential moving average, we try to indicate the buy or sell signal. Suppose it is 9-day MACD, and our difference between the 12-day and 26-day I am putting in dotted lines. It crosses the 9-day moving average. So this is a point of sell. This is a point of buy. It is indicated at these points when we use moving average, convergence, and divergence. Similarly, we have a second technique called as relative strength index, where we calculate the relative strength index by using the relative strengths, and we can predict if the market is bullish if relative strength index is between 40 to 90. If it is between 0 to 60, it is a bad market, or we can say bearish market. Now, with this, the charts, the technical indicators that we have under technical analysis, we conclude our session. Thank you.